Hi, everyone. My name is Mario Ichridio. I'm the Senior Wealth Advisor with SRP, and I'm joined here by Bob Wagner, our Chief Investment Officer. And we just wanted to give you all a quick update on some changes we made in the portfolio recently, given everything going on, both today as well as what we feel is going to happen going forward in the future. So, Bob, you and I have been looking at the portfolios. Really, we look at them weekly, but more in depth the last few weeks, given what's happening with this whole debt ceiling issue that we've been facing, as well as the continued rise in interest rates, and what we felt was working in the past, mainly in 2022 and 2021. We just don't feel the same way really going into 2023. So one of the things we want to talk to you quickly about, it's really the biggest changes we're making. It's due to this thing called the yield curve and what's happening in the bond market. So Bob, this doesn't look new to you, but this is something that you and I spent a lot of time looking at. It's what is happening with U.S. debt, specifically treasuries. And
Yeah,
isn't it fascinating just how fast yields have moved within, the last 2 years?
yes. This is a historic move in the market. As you remember, last year was one of the worst years on record for the 60-40. The bonds were down double digits, almost as far down as equity. So last year was a historic move. Now, if you remember last year, what did we want to do? We wanted to diversify away from fixed income, and we wanted to shorten the duration. Well, things have dramatically changed since then. We had the rates rise across, we had a parallel shift, and then we started to have it torquing, meaning the long end was falling and the short end started to rise. And so because of that, what we've done is we've recently realigned the portfolios to get rid of the diversification assets. We wanted to stay focused on the interest rates now because we're getting nice yields across the yield curve. We wanted to do what's called a barbell. We have short-term instruments to capitalize on the much higher yield on the short end, but because rates are falling on the long end, we wanted exposure on the long end as well. So we have a portfolio that's matching the duration of the ag bond as the second holding. So we have very short, we have 50% in very short end, and we have 50% in the ag duration range of the yield curve.
Yeah, and I think the biggest thing there too, Bob, this is also driving our reasoning for being market neutral. Because one of the things that the yield curve is showing us, it's right now short-term rates, things that are less than, call it 2 years, are paying more interest than things that are further out in the bond curve. So looking at a 7-year, 10-year. Usually it's the opposite. These longer-term bonds should be paying you more. So when we see interest rates above 5% on the short end, that's why we're making the moves that we are to do the barbell approach with half the portfolio in the bond side going to short-term bonds. And then we're also looking to somewhat hedge our risk against a recession by buying some longer-term debt. Because that's what happens during a recession. People get scared about equities, so they go into the bond market, specifically longer-term bonds.
Yeah, we want to cover ourselves for both scenarios. If rates keep going higher, we want that short end covered because that's where we're getting the yield. If we do slip into a recession, we want that long end because we want the gain from the falling interest rates. And so that's exactly why we're implementing a barbell. Then as things develop, we'll decide, do we want to go more short or more long?
Exactly. So even so, the one biggest change we made too, it's on the equity side. So if looking backwards, most of our portfolio on the stock side or equities has been really heavy towards value. So companies that pay a dividend, companies that have stronger balance sheets, companies that have sustained earnings. But right now, the change we've made is to go more and more market neutral. And Bob, why don't you explain why we did that?
Okay, we're going more market neutral because as you remember last year, we were skewed towards value. Energy was one of the leaders. Well, looking forward, we're probably there's a large probability that we might slip into a recession. Now, if we slip into a recession, we want to stay away from the economically sensitive. That would be energy. Why this one's a little bit different, because normally we would go towards value in a recession. However, this time we have a banking situation that's making us real nervous about the financial sector, which is a large weight within the finance. Also, if you see how markets have been behaving, growth, especially the large cap growth, is almost becoming like the safe haven. So because of that uncertainty going forward, we wanted to play it safe, come close to the benchmark, and use what we call consistently good, occasionally great to find funds in that category that just simply add value to the benchmark.
Well, that's good. So I think the change we made really, looking backwards, worked in the past, but going forward, again, we just want to make sure that we're tracking the index. But even so, the biggest changes are due to the bonds here. So I appreciate everyone taking time to watch our video and kind of get an understanding of the change we made in your portfolio. And Bob, thanks for your time and jumping in and walking us through
Sure.
kind of what you're looking at on a daily basis. But if you have any questions, feel free to reach out to your advisor and enjoy the rest of your week, everybody.